Hi, my name is Jim and I was retired. This has been a busy week. We saw another unusually large increase in the Fed funds rate, which will lead to higher interest rates for many of us. The next day, we had the initial reading for the second quarter GDP, which showed the second quarterly decline in the economy, which meets the standard definition of a recession. And then today, we saw the most recent indication of persistent inflation. So, higher rates, recession, or inflation. Stay tuned as we tackle the question, which do you fear? So, a common definition of a recession had been 2 quarters of negative growth in the gross domestic product. First quarter GDP was a negative 1.6%. And yesterday, we had the first official reading from the Bureau of Economic Analysis for the second quarter, and it came in at minus 0.9%. So that's 2 quarters of negative growth as shown on this chart from the BEA. So naturally, everybody says that's no longer the definition of a recession. After all, Chairman Powell said the day before, I do not think the U.S. is currently in a recession, and the reason is there are too many areas of the economy that are performing too well. So here's a clarification on that common definition. This pair of negative quarters under the prior administration was a recession, and this pair under the current administration is not a recession. As I've covered in a prior video on changing definitions and inflation in general, there is technically a definition of a recession that's declared by the Business Cycle Dating Committee of the National Bureau of Economic Research. It's a non-governmental research group of monetary economists that meet to decide on how to date a recession. You can almost imagine 8 economists sitting in a conference room trying to decide whether to swipe right or left to date this recession. So are we in a recession? As a DIY retiree with no plans to join the labor force, I'm less concerned about how to define a recession. If you're looking for a job, a recession is a terrible thing. I reminded you what Reagan said, that a recession is when your neighbor loses a job. A depression is when you lose your job. So if you're in the labor force, a recession is more harmful to the immediate future than inflation. A recession is a slowdown on the economy, and eventually it affects the labor force. It hasn't so far, but it generally means depressed investment returns for all of us. But if you employ a 3-bucket system, you know how to lock in some savings that are protected, a cash cushion in bucket 1, so that you don't have to sell when the market is down. So as a retiree and a saver, I'm more concerned about inflation, which taxes everybody with higher prices. And unless you can get earnings from investments that outpace inflation, you're going to erode your investments as well. This morning, we got the most recent reading from the Personal Consumption Expenditures, the PCE Price Index from the Bureau of Economic Analysis. And that PCE index is the Federal Reserve's preferred inflation measure. So as you recall, the CPI, or Consumer Price Index, was 9.1% in June, and this PCE reading came in at 6.8%. Either way you measure it, we're at 40-year highs. Now, I've shown this movie before. Inflation expectations, measured by Michigan, tracks PCE, and the Fed funds are supposed to try to contain those. Where we are right now, Well, the PCE at 6.8% is more than 3 times the 2% target for inflation. And the Fed funds rate is only 2.5% at the upper range. So we are far, far from where we need to be to contain inflation. If the Fed continues with 75 basis points, by the end of the year, they'll reach 4.75%. And if they go with a 50% basis, they're only going to get up to 4% by the end of the year. And if they go with quarter points any of the next 3 meetings, they will not even pass 4.0. Now, I've also focused on this before, that the last time the Fed raised rates back here in 2017 and 2018, inflation was running close to 2%, barely over it, but they thought the need to control inflation, so they raised the rates here. And it only started to bring down PCE in the green line once the Fed funds rate exceeded PCE. And they kept it there for a while to make sure PCE was under control, and then brought down the Fed funds rate. Then the pandemic happened and everything went to zero bound again. PCE started climbing, and we really should have been tackling it back here in early 2021. But now we're chasing PCE. We need to get above it to contain PCE. As a retiree, should you be more worried about runaway inflation or a recession? This DIY retiree is more concerned about runaway inflation. I've seen that movie before, and it doesn't end well. Now, retirees can do things to prepare for a recession, especially if you use a bucket system like I do, and you have a cash cushion to ride out a market downturn. So you're not selling assets at a market decline. You're not locking in losses. You can let the market ride and hopefully recover by the time you need to sell assets. To fight inflation, we all need to focus on reducing expenses and saving as much as we can, again, to build up that cash cushion to fight both a recession and inflation. Check out my playlist for inflation on more information on how to fight inflation. So I'll conclude with my standard warning. I am not a financial planner or an economist. I have no special initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next time.